Even though people have been getting oil from natural sources like tar pits for a long time, it wasn't until the 1800s that new ways to dig it up and make it useful were developed. This led to finding a lot more oil and using it for many different things. In the middle of the 1800s, people started drilling for oil in places like Baku in Central Asia, where they had been getting oil in simpler ways for a long time. Other places like Poland and Romania also started refining the oil they found. By the end of the 1800s, Russia was producing more oil than anywhere else in the world. In America, Edwin Drake drilled the first oil well in 1859 near Titusville, Pennsylvania. He found oil really quickly, just 69 feet down, which started a big rush to find more oil across North America, including in Ohio, Texas, California, and Alberta, Canada. The discovery of oil at Spindletop in Texas in 1901 made America a major oil producer. Around the world, big oil fields were discovered in places like the Dutch East Indies, Persia, Mexico, and Venezuela over the next 50 years. As more oil became available, more industries started using it because it was easy to transport and didn't cost much. By the early 1900s, oil had become a big deal, making a lot of money for countries where it was found. Big companies, not just countries, started popping up to handle everything from finding oil to making and delivering it. Royal Dutch Petroleum from the Netherlands, Anglo-Persian Oil Company from the UK, and Standard Oil from the US were some of these big companies. Standard Oil, started by John D. Rockefeller in 1870, began as an oil refining company, but soon became a major player in the oil business in the US and around the world. It first grew by buying up other companies doing similar refining work to get bigger and have more control over the market. By 1890, Standard Oil controlled almost all the refining in the US and had big operations in places like the Middle East and China. Later, Standard Oil started buying companies that supplied things it needed, like oil, or sold its products, like gas stations. This made it even more powerful in the oil industry. It could control the price of crude oil from producers and set prices for gas high enough to make a profit, but low enough to keep competitors out. In 1911, the government wanted to break up big companies that had too much control, monopolies, under the Sherman Antitrust Act. They decided Standard Oil was one of them and split it into 34 smaller companies. Some of these companies still exist today, like Esso, Mobil, Chevron, Amoco, and Pennzoil, which are now part of some of the biggest oil companies around. Even as the oil industry in the United States was being made less controlled, the parts that found and got the oil were becoming more controlled. In the 1920s, when oil prices dropped a lot, because people drilled too much, the government and big oil companies worked together to control how much oil was made. When companies work together to set higher prices, or when the government makes them do it, it's called a cartel. The first oil cartel started in Texas with the Texas Railroad Commission, TRC. They wanted to stabilize oil prices by limiting how much oil could be made in Texas. After a big oil find in East Texas in 1930, the TRC used martial law to make sure the rules were followed. Since the US and Texas were big in oil production, the TRC could control global oil prices for 50 years. At the same time, big oil companies from around the world, called the Seven Sisters, tried to control oil prices too. They included companies like Exxon, Mobil, and Shell, and they did things like sharing markets and setting prices to protect their profits. These companies not only controlled oil in the US, but also had control over oil in places like Saudi Arabia and Iraq. Together, they controlled most of the oil sold around the world, and they were called international oil companies, or the oil majors. By World War II, in the late 1930s and 1940s, oil became really important. Germany tried to invade Russia to get oil, and Japan invaded Southeast Asia for the same reason. Winston Churchill even decided to use oil instead of coal for the British Navy, which helped them fight the Germans. After 1945, many countries in the world became independent and started making their own governments and infrastructure. In places with a lot of oil, like the Middle East, new governments worked with big oil companies to find and sell oil. This helped both sides make a lot of money and become powerful in the oil industry. Birth of OPEC. In the second half of the 1900s, more and more oil was being produced in places like the Middle East, South America, and Southeast Asia. Around 1949, countries like Venezuela, Iran, Iraq, Kuwait, and Saudi Arabia started talking about working together to have more power in the oil market, especially against big oil companies. In 1960, because big oil companies were lowering oil prices, these 5 countries formed a group called the Organization of the Petroleum Exporting Countries, OPEC. Other countries like Libya, United Arab Emirates, and Nigeria later joined too. The main goal of OPEC was to coordinate their oil policies, but they mainly focused on limiting how much oil they exported to make oil prices go up. OPEC's main office is in Vienna, Austria, and they meet twice a year to make decisions. Each country has a vote, and they all need to agree for any changes to happen. OPEC also set up a standard price for oil called the OPEC Reference Basket of Crudes, which includes prices from different member countries. Oil shocks and their impact. In the 1970s, tensions heightened between OPEC, Organization of the Petroleum Exporting Countries, non-OPEC oil producers, and major international oil companies, IOCs. Emerging oil exporting nations such as Venezuela, Iran, Iraq, Kuwait, and Saudi Arabia sought to assert control over their oil resources. This led to renegotiations of contracts with IOCs, and in some cases, nationalization of oil assets, with governments establishing national oil companies, NOCs, to manage resources. Leaders like Muammar al-Gaddafi in Libya and Saddam Hussein in Iraq utilized oil as a geopolitical tool to challenge Western dominance. First oil shock, 1973. Triggered by the Yom Kippur War, Arab OPEC members imposed an oil embargo on countries supporting Israel, including the United States and its allies. Oil prices quadrupled within months, leading to economic turmoil and recessions in oil-importing countries. Systemic factors, including declining U.S. oil production and the transition away from the Bretton Woods system, exacerbated economic vulnerabilities. Second oil shock, 1979. Following the Iranian Revolution and the subsequent nationalization of Iran's oil industry, global oil prices surged again. Economic uncertainties persisted due to incomplete adaptation after the end of the Bretton Woods system, exacerbating the impact of rising oil prices. OECD countries faced severe recessions, marked by high inflation and unemployment rates, with prolonged recovery periods. Shift in power dynamics. By 1986, global oil prices plummeted, weakening OPEC's influence as oil-importing nations diversified energy sources and improved efficiency. Oil-importing countries benefited from investments made in fuel efficiency technologies and alternative energy resources during the 1970s. Spare production capacity in OPEC countries limited their ability to collectively control oil prices, leading to increased competition in the global oil market. Geopolitical impacts. The Gulf Wars in 1990-91 and 2003 disrupted global oil supply chains and contributed to oil price spikes. The 1990-91 Gulf War, triggered by Iraq's invasion of Kuwait, resulted in substantial damage to Kuwait's oil infrastructure and a subsequent oil price shock. The 2003 Gulf War, while ostensibly aimed at removing Saddam Hussein from power, also aimed to control Iraq's substantial oil reserves. Current challenges. Ongoing geopolitical tensions in the Middle East, coupled with high and volatile oil prices, pose challenges to global energy security. Price collapses in 2014-2016 caused budgetary constraints for both OPEC and non-OPEC oil-producing nations. Discussions between OPEC and non-OPEC producers, including Russia, continue to manage oil production quotas in response to fluctuating market conditions. Finally, stay ahead in the dynamic world of energy markets by subscribing to the Energy Markets Training Initiative on YouTube and following us on LinkedIn. Our channel and page offer valuable insights, tutorials, and updates on trading strategies, market trends, and industry developments. By subscribing and following us, you'll gain access to exclusive content that can enhance your understanding and proficiency in energy trading. Don't miss out on the opportunity to stay informed and connected. Subscribe to our YouTube channel and follow us on LinkedIn by clicking the links below.